So in the dividend space, JEPI and DIVO are two of the most popular right now, and for good reason. They are fantastic investments, great performance, especially during this past very turbulent year in the market. For those that follow the channel, you know that I personally invest in both of these funds because I think they are some of the best for what they're trying to do. And both the JEPI and DIVO have a similar objective: good overall total returns with less overall volatility and a high level of monthly income. But do keep in mind that investing is not a team sport. You shouldn't get emotionally attached to either of these funds, and if you can find something better, you should be all about that. And that's why in this video I want to present two very compelling competitors to DIVO and JEPI. These have very similar strategies and shockingly good performance. So I'm very excited to dive into this. If you guys enjoy, leave a like, subscribe, and let's do this. Okay, so let's begin with CII, that is the ticker, and the name is Enhanced Capital and Income Fund. So immediately you can see how this is in the same category as the other two funds. And to be specific, my opinion, CII is more closely related to something like JEPI than DIVO. You should also be aware that this is a closed-end fund, so it's not an ETF, and thus the expense ratio is substantially more. The current expense ratio is right here, so 0.85 for the management fee, and I think the overall fee is actually 0.9%. Yeah, the gross expense ratio is 0.9. Now, being that this is a closed-end fund, it does trade at premiums and discounts relative to the asset value, and at this moment in time, it is trading at a discount of 1.32%. And the objective here is to invest in a portfolio of equity securities of US and foreign issuers. The trust may invest directly in these securities or synthetically through the use of derivatives. They also employ a strategy of writing covered calls and put options. To give you more data on the call option strategy, they do it on single stocks versus an index approach, and currently they overwrite about half of the portfolio. And in terms of the holdings, 92% are US-based companies, and then we have the United Kingdom at 2.5% and France at a similar 2.4%. And here's the best data I can find on the actual holdings as of September 30th, 2022. So we have the stock name over here along with the value in this column. And as we look at this, we can see a concentration of large cap US companies. It is similar to the S&P 500 in terms of the top holdings are big tech like Google, Meta. Amazon is a pretty big holding. Microsoft is definitely somewhere here, and Microsoft right here at a pretty big valuation. But do note that in comparison to the S&P 500, there's a lot less holdings. In fact, I think this page is all of it. Now, getting to the dividend, the yield is 6.66%. So that is less than JEPI, but still way above the market average, largely thanks to that covered call approach. And you're also going to note that the growth rate of the dividend is very high, and this is thanks to the managed distributions of a closed-end fund. So if we navigate to the actual dividend history, we can see the physical monthly dividend payments, and you can see just how managed they are. So at the moment, it's at almost 10 cents per share. They did have a special dividend just last month at $1 per share. But going back in time to 2021, they raised the dividend 2 separate times. In 2020, the dividend was consistent. And in 2019, a little bit of red flag, we do have a cut in the dividend for a couple of months. Now, unlike many other covered call funds like JEPI, this has an extensive history. It's been around since I think 2013, and since then it's had an annual total return of 11.3%. Over that same time, if we put in the S&P 500, it has a return of 12.12%, so very similar. Now, if we compare that to JEPI, of course, the time frame is significantly less. It only goes back to May of 2020, but over that time, it's had an annual return, total return of 13.94%. And over that same time period, CII has an annual total return of 18.57. So I found that to be a super fascinating comparison, and let me know in the comments below which one do you think is more compelling. And the next very interesting comparison is with DIVZ against the good old DIVO. So for DIVO, we all know that this is an actively managed ETF that focuses on dividend growth companies. It's relatively concentrated at around 25 holdings, and they also utilize a covered call strategy on individual holdings to, again, boost the yield. Now, DIVZ is actually shockingly similar So again, we have an actively managed approach. It is also concentrated at 25 to 35 holdings, and they focus on businesses that pay attractive dividends that are expected to grow that over time while currently trading at favorable valuations. The big difference is that this has no covered call strategy, which might be more appealing to you depending on your needs. But due to the lack of covered calls, the yield is much more in line with a regular dividend ETF, and at the moment it's 3.23. Now this ETF is on the new side, so the performance and the historical record is a limiting factor here, but we do see the beginnings potentially of some dividend growth happening. And since the inception date back in the beginning of 2021, it has an annual total return of 11.81%. And comparing that to the S&P 500 over the same time, it has a return of only 4.52, but compare it against something more similar like DIVO, over the same time, DIVO has a return of 11.39, which is almost identical. So there you have it, guys. JEPI and DIVO are both two of the absolute best value dividend income funds on the market. But they're by no means alone. There's constantly new competition on the market, and funds like CII and DIVZ might be worth your consideration if you're interested in these kinds of funds to begin with. Let me know your thoughts in the comments below. If you guys enjoyed, leave a like, subscribe, and I'll see you guys in the next one.